Hello, I'm John AG, and there's a moment I want you to think about before we talk about silver, markets, or numbers. It's that instant when you realize something you trusted isn't actually broken, but it also isn't telling you the truth anymore. Nothing dramatic happens, no alarms, no headlines, just a quiet mismatch between what you're shown and what you sense. The system still works, yet it no longer feels reliable. That feeling is subtle, almost easy to ignore, and that's exactly why it matters. Because the most important market shifts don't announce themselves as crises. They begin as inconsistencies you're encouraged to dismiss. Most people believe markets fail loudly. They imagine defaults, freezes, or sudden collapses. But in reality, markets usually fail softly first. They stretch. They reroute pressure. They continue functioning while becoming less honest about what they represent. Silver, right now, is sitting inside that soft failure zone where prices still print, contracts still trade, and explanations still sound reasonable, even as the underlying structure starts to feel strained. The comfort most investors rely on comes from paper. Futures prices, ETF charts, spot quotes refreshing every second. These feel precise, scientific, authoritative. They give the impression that reality is being measured continuously and accurately. But paper prices are not reality. They are agreements. And agreements only hold as long as the assumptions behind them remain intact. When those assumptions weaken, price can continue moving while meaning quietly drains away. This is where the false comfort begins. When silver prices collapsed sharply after reaching record highs, the explanation arrived instantly. Margin requirements were raised, the dollar strengthened, expectations around Federal Reserve policy shifted, profit-taking accelerated. All of this is true, and none of it explains the full picture. These explanations describe the mechanics of selling, not the reason the market was vulnerable to those mechanics in the first place. To understand that vulnerability, you need to look at one simple mechanism before anything else overwhelms it. On the COMEX, the primary exchange for silver futures in the United States, there are two numbers that define the entire structure. One is registered silver, the metal that is physically sitting in approved vaults and available for delivery. That figure currently sits around 100 to 120 million ounces. The second number is open interest, the total silver represented by outstanding futures contracts. That number is roughly 429 million ounces. When you place those side by side, the imbalance becomes impossible to ignore. Roughly 4 ounces promised for every 1 ounce that can actually be delivered. Under normal conditions, that ratio doesn't cause stress. Most futures contracts are never meant to result in physical delivery. They are rolled, closed, offset, or settled in cash. The system functions because participants behave predictably. Confidence fills the gap between promise and resource, but confidence has a critical weakness. It depends on nobody testing the system too aggressively, all at once. Recently, that behavior has started to shift. In a single month, roughly 40 million ounces of silver were ordered for delivery on the COMEX. Not traded, not hedged, ordered. When total registered inventory is only around 110 million ounces, numbers like that stop being abstract. They become physical constraints. At that pace, even a modest increase in delivery demand changes the conversation from unlikely scenario to mathematical pressure. This is where the delayed risk enters quietly. If just a quarter of contract holders demanded delivery instead of cash, the exchange would not have enough silver to meet those obligations. That doesn't mean the exchange would shut down. It means it would be forced to rely on its rulebook rather than its vaults. And that distinction matters far more than most people realize. The rulebook offers comfort, cash settlement clauses, force majeure provisions, emergency procedures. These are often cited as proof that the system cannot fail. But these rules don't eliminate risk. They relocate it. They shift the burden from physical delivery to confidence in substitution. Cash settlement works only if participants agree that cash is an acceptable replacement for metal. The moment that belief weakens, the system remains operational but loses credibility. Here's where silver becomes uniquely revealing. If the paper price of silver were truly reflecting weak fundamentals, physical metal should be abundant. Dealers should be eager to sell. Premiums should collapse. Inventory should pile up. Instead, the opposite has happened. Many dealers report extreme difficulty sourcing physical silver. Some have halted sales entirely, not because demand disappeared, but because supply could not be secured at paper prices. This is not speculation. It's observable behavior in the physical market. That disconnect is the signal most people miss. Paper prices fell sharply, yet physical availability tightened. One of these markets is misrepresenting reality, and history suggests it is rarely the physical market that lies for long. This same pattern appeared during the early months of 2020, when silver prices fell, while physical metal became scarce. Back then, the explanation was logistical disruption. Today, logistics are functioning. The strain is internal. To understand why that matters, you have to look beyond silver itself. Silver sits at a dangerous intersection. It is both a monetary metal and an industrial input. It responds to confidence in currencies and to real-world production needs. Solar panels, electronics, electric vehicles, and emerging technologies tied to data centers and artificial intelligence all require silver. These industries do not reduce demand because a futures chart looks weak. Their demand is functional, not emotional. At the same time, mine supply has failed to respond meaningfully. Years of underinvestment, regulatory hurdles, and silver's role as a byproduct metal have constrained output. This creates a structural supply deficit that doesn't resolve quickly. You cannot mine confidence into existence. You cannot refinance ounces. Supply responds slowly, even when prices rise. Second-order effects begin to appear when these forces collide with market mechanics. Margin hikes force leveraged traders to sell regardless of fundamentals. That selling drives prices lower, which reinforces the appearance of weakness, even as physical demand remains strong. The market becomes less about price discovery and more about position management. Volatility increases not because information is changing, but because leverage is being flushed out. This creates psychological disorientation. On one side, charts signal collapse. On the other, physical scarcity signals stress. Investors are told both are true and neither should concern them. The temptation is to choose the narrative that feels safer. Either the system is fine and this is noise, or everything is about to break. Reality is more uncomfortable. Systems rarely fail in clean, cinematic ways. They strain, adapt, and obscure their weaknesses until confidence thins enough to matter. History, when reframed honestly, doesn't tell us that markets always survive unchanged. It tells us they preserve function by altering meaning. Bretton Woods did not end with empty vaults. It ended when convertibility became politically and mathematically inconvenient. The system continued. The promise changed. Those holding paper claims learned, after the fact, that assumptions are not guarantees. Silver today is not announcing a collapse. It is whispering about stress. The imbalance between physical inventory and paper claims is widening. Delivery behavior is shifting. Physical availability is tightening despite falling paper prices. None of this requires panic. It only requires attention. The danger is not missing a rally or a dip. It is mistaking continuous operation for structural health. At this stage, nothing dramatic needs to happen for the situation to matter. Confidence erodes incrementally. Participants adjust quietly. Rules are leaned on more heavily. Each step feels reasonable in isolation. Together, they signal that the translation layer between physical reality and financial pricing is under strain. The question to hold, without rushing to answer, is not whether silver goes up or down next week. It's whether the system that translates ounces into promises is becoming less elastic under pressure. If that elasticity weakens, even temporarily, price stops being a reliable guide to reality. And when that happens, markets don't feel dangerous. They feel confusing, which is often far worse. If part one was about noticing the strain, this part is about understanding why that strain doesn't release cleanly. Most people assume markets correct the way springs do. Pressure builds, price snaps back, balance is restored. But that metaphor only works when the system is elastic. When a system becomes rigid, pressure doesn't resolve, it transfers. And transferred pressure is far more dangerous because it hides. The greatest source of false comfort in the silver market right now is the belief that rules equal safety. Futures exchanges have rulebooks thick with contingencies, margin adjustments, position limits, settlement alternatives, emergency powers. To many participants, these are guardrails. Proof that no matter what happens, there is a controlled outcome. But rules do not create metal. They only determine how scarcity is distributed when metal matters. Cash settlement is the clearest example. It is often described as a neutral technicality, a harmless alternative when delivery is inconvenient. In reality, it is an admission that delivery cannot always be guaranteed. Cash settlement preserves the appearance of continuity while changing the substance of the contract. A promise of silver becomes a promise of currency. That distinction seems trivial until confidence in currency itself becomes part of the stress equation. Silver does not exist in isolation from monetary conditions. It reacts to them. When government debt expands, when deficits normalize, when currencies are managed through policy rather than restraint, precious metals attract attention not because people are emotional, but because they are logical. Gold absorbs this logic first. Silver absorbs it later, but with more violence, because its market is smaller and less forgiving. What complicates silver's role further is that it cannot retreat fully into abstraction. Industrial demand anchors it to physical reality. Solar panels do not care about settlement clauses. Electronics manufacturers cannot hedge shortages away forever. When supply tightens, they either secure material or production suffers. This creates a floor of real demand beneath the financial layer, even when paper prices suggest weakness. The supply side, meanwhile, remains stubbornly unresponsive. Silver production has not meaningfully accelerated despite higher prices over recent years. This is not because companies are irrational, but because silver is rarely mined on its own. It is extracted alongside copper, lead, zinc, and gold. Investment decisions are driven by those primary metals, not silver's spot price. Even when silver prices surge, supply does not surge with them. This lag is structural, not cyclical. As a result, deficits persist. Demand quietly exceeds new supply year after year. Inventories decline slowly, then suddenly become relevant when delivery behavior changes. That is exactly what we are seeing now. The jump in physical delivery requests is not random. It reflects a shift in preference. Some participants no longer trust paper exposure to represent real access. They want metal, not price movement. This is where second-order effects begin to compound. Exchanges respond to stress by increasing margins. Higher margins force leveraged participants to exit. Forced exits drive prices down. Lower prices reinforce the appearance of weakening demand, even if the demand being removed was purely financial. Meanwhile, physical buyers often step in at lower prices, but they do so quietly, off-exchange, through dealers and refiners. The paper market sees selling. The physical market sees absorption. Over time, this dynamic changes who remains active. Speculators thin out. Liquidity narrows. Price becomes more sensitive to fewer actors. Volatility increases because each transaction carries more weight. Observers misinterpret this volatility as instability, when in fact it often signals that excess leverage has already been removed. The danger lies not in the volatility itself, but in misunderstanding what it represents. History, when stripped of mythology, shows that markets rarely implode from obvious shortages. They fracture from mismatched expectations. In the late stages of the gold standard, convertibility didn't end because gold disappeared. It ended because honoring convertibility became incompatible with policy goals. Authorities chose continuity over promises. The system survived. The meaning of claims changed. That same logic applies here. If silver delivery becomes inconvenient at scale, the exchange does not need to fail. It only needs to reinterpret obligations. Cash settlement becomes normalized. Delivery is discouraged through incentives rather than bans. From a legal perspective, nothing breaks. From a confidence perspective, something fundamental shifts. This is the midpoint where thinking must change. The question is no longer, will there be a COMEX default? That framing is too crude. The more important question is whether the futures market remains the primary mechanism for price discovery in silver, or whether it slowly loses that role to physical premiums, regional pricing, and alternative venues. Markets can survive losing relevance. Participants who don't notice the transition often don't. Consider what happens if physical silver consistently trades at significant premiums to futures prices. Arbitrage should close that gap, but arbitrage depends on reliable delivery. If delivery becomes uncertain or delayed, arbitrage weakens. Price signals fragment. Different markets tell different stories. Investors accustomed to a single authoritative price begin encountering contradictions. Confusion increases. Trust erodes incrementally. None of this requires a dramatic catalyst. It requires time and rational behavior. Industrial users hedge less and stockpile more. Investors favor physical exposure over paper promises. Dealers adjust premiums to reflect sourcing difficulty. Exchanges adjust rules to manage flow. Each decision makes sense individually. Collectively, they alter the structure of the market. This is where the practical reframe becomes essential. Instead of asking whether silver is bullish or bearish, ask where stress is being absorbed. Is it being absorbed by price, by leverage, by rules, by confidence? Stress absorbed by price is visible and finite. Stress absorbed by confidence is invisible and cumulative. The latter is far harder to reverse. Another useful lens is optionality. Who has options and who doesn't? Leveraged traders have limited optionality. They must respond to margin calls. Industrial users have limited optionality. They must secure inputs. Exchanges have optionality through rules. Long-term holders of physical metal have optionality through patience. Understanding which participants are constrained explains why prices move the way they do under pressure. Time horizon resolves many apparent contradictions. Short-term charts capture forced behavior. Long-term fundamentals capture necessity. When these conflict, volatility bridges the gap. Silver's violent moves are not anomalies. They are the mechanism through which incompatible timeframes attempt to coexist in a single price. What remains unresolved is whether confidence can continue to substitute for delivery indefinitely. As long as most participants treat futures as financial instruments rather than claims, the system holds. But behavior has already begun to shift at the margins. Delivery requests are higher, physical sourcing is harder, premiums are stickier. These are not signals of collapse, they are signals of adaptation. The danger is assuming adaptation equals stability. Adaptation often precedes transformation. Markets rarely announce when they are becoming something different. They simply stop behaving the way you expect. Those still using the old framework feel whiplash. Those who adjusted early feel nothing at all. At this point, silver is not asking you to panic. It is asking you to pay attention to where assurances come from. Are they grounded in resources or in rules? Are they supported by supply or by procedure? Those questions matter far more than any short-term price target. Because if the system's strength increasingly depends on how creatively rules are applied rather than on how readily metal is delivered, then price is no longer a clean expression of reality. It becomes a managed outcome. And managed outcomes can persist longer than expected, but they always leave traces for those willing to look closely enough. By the time a system reaches this stage, the most important changes are no longer technical. They're psychological. They happen in the way participants interpret signals, in what they stop expecting, and in what they quietly begin preparing for without saying so out loud. Markets don't need everyone to lose confidence to change. They only need a critical minority to stop behaving as if the old assumptions are guaranteed. This is why the final phase of stress rarely looks dramatic. It looks procedural. It looks like small adjustments justified as prudence, a margin increase here, a settlement clarification there, a delay framed as routine. Each step feels reasonable in isolation. Together, they mark a shift from a system that assumes abundance to one that manages scarcity. Silver is now operating in that transition zone. The paper market continues to function, but it requires more intervention to do so. Margins are raised more frequently. Volatility is tolerated rather than smoothed. Cash settlement becomes less hypothetical and more normalized as a contingency. None of this is accidental. It reflects a system that is still liquid, but less forgiving. The deeper issue is not whether silver can be cash settled. It always could be. The issue is what happens once participants internalize that cash settlement is the expected outcome under stress. At that point, a futures contract subtly changes identity. It stops being perceived as a claim on metal and starts being treated as a wager on policy, rules, and timing. That is a very different instrument, even if the contract language remains unchanged. This shift matters because silver's importance is not confined to finance. Industrial users cannot afford to think in abstractions. When availability becomes uncertain, behavior changes in ways that never show up immediately on an exchange screen. Companies secure longer-term supply agreements. They increase inventories. They pay premiums to avoid disruption. These actions reduce free-floating supply further, tightening the physical market, even if paper prices suggest weakness. At the same time, investors watching gold's behavior begin to draw conclusions. Gold nearing $5,000 an ounce is not just a price event. It is a signal about trust in currencies, debt sustainability, and policy credibility. Silver historically lags gold in these moments, not because it is less sensitive, but because its market structure delays the adjustment. When it moves, it tends to do so abruptly because the repricing happens across fewer ounces and thinner liquidity. The gold-to-silver ratio reflects this tension. When the ratio is elevated, it often indicates that silver has not yet fully responded to the same forces driving gold. That doesn't dictate timing, but it does suggest potential energy building beneath the surface. Energy in markets doesn't dissipate gently. It releases when constraints give way, or when behavior shifts enough to overwhelm the mechanisms containing it. Policy responses add another layer of complexity. Central banks and exchanges are not neutral observers. Their mandate is stability, not purity of price discovery. When instability appears, they act to dampen it, even if that means distorting signals temporarily. This is rational from an institutional perspective, but it also means that markets under stress become less transparent, not more. One unintended consequence of repeated intervention is that participants begin to second-guess signals. Price moves are no longer trusted as expressions of supply and demand alone. They are interpreted through the lens of policy reaction. This creates hesitation. Liquidity becomes cautious. Fewer participants are willing to take the other side of trades during stress, which paradoxically increases volatility when trades do occur. In this environment, the concept of risk needs to be reframed. Risk is not simply price fluctuation. Risk is reliance on assumptions that no longer hold consistently. For years, the assumption in silver has been that physical delivery is a niche concern. That assumption is now being tested at the margins. Testing doesn't require failure. It only requires repetition. Every month that delivery demand remains elevated, every report of sourcing difficulty, every instance where premiums remain stubborn despite falling paper prices, adds weight to the same question. Not asked publicly, but considered privately. How reliable is this market as a bridge between money and metal? This is where time horizon becomes decisive. Short-term participants experience this phase as confusion. Signals conflict, moves reverse violently, narratives flip weakly. Long-term participants experience it as noise, layered over a slow structural process. Neither experience is wrong, but danger arises when short-term interpretations are applied to long-term decisions, or when long-term assumptions are used to justify short-term leverage. A useful mental model here is to think in terms of pressure valves. In a healthy system, pressure is released through price. Prices rise, demand cools, supply responds. In a constrained system, pressure is released through rules, behavior changes, and substitutions. Cash settlement is a pressure valve. Margin hikes are pressure valves. They don't eliminate pressure, they redirect it. The question is where that redirected pressure goes. In silver's case, much of it goes into the physical market, into premiums, into delivery timelines, into off-exchange transactions. Those areas are harder to measure, less visible, and easier to ignore. But they are also where reality asserts itself first. None of this implies inevitability. Markets can stabilize in unexpected ways. Demand can soften. Substitutes can emerge. Technology can reduce usage per unit. Policy can restore confidence. But those outcomes are possibilities, not guarantees. What is guaranteed is that assumptions are being tested, and tests reveal weaknesses long before they produce outcomes. The most unsettling aspect of this phase is that clarity feels just out of reach. There is no single data point that resolves the tension. No announcement that confirms or denies the risk. Instead, there is accumulation. Small signals pointing in the same direction without converging into a headline. This is uncomfortable because it denies closure. People naturally seek resolution. They want to know whether silver is going to surge or collapse, whether the system will hold or fail. But markets rarely offer answers on demand. They offer evidence. And evidence requires interpretation without certainty. At this point, the most important discipline is not prediction, but coherence. Does the story you're telling yourself about silver align with how the system is actually behaving? Or does it rely on assumptions that are being quietly stretched? Are you treating continuous operation as proof of health, or are you distinguishing between function and robustness? The final question is not about price targets or timelines. It's about trust. Trust in translation. Trust that an ounce promised is meaningfully connected to an ounce delivered. Trust that rules exist to facilitate markets, not to replace their foundations. When that trust weakens even slightly, behavior adapts. And adapted behavior changes markets long before headlines do. Silver does not need a crisis to matter here, it only needs persistence. Persistent deficits, persistent delivery interest, persistent physical tightness, persistent reliance on procedural solutions. Over time, persistence reshapes expectations. Expectations reshape behavior, and behavior reshapes markets. So the question to sit with is not whether silver will shock the system. It's whether the system is quietly teaching participants to expect less from its promises, and whether that lesson once learned can ever truly be unlearned.